Hi, everyone. Welcome back for another episode of Amplified Wealth, where we chat today with longtime wealth advisor at the firm, Carmine D'Avino. Austin, Carmine, and I dive into a whole host of market isms or beliefs that we think just simply aren't true. We discuss timing the market, seasonality, return patterns, debunk whether investing is like gambling, discuss what sorts of market volatility are normal, and whether cash investors should wait for a pullback, dollar cost average, or just throw it all in. We also look at whether geopolitical tensions that are going on, or even elections that are coming up, are causes for concern. And lastly, we explore the impact of new technologies, whether it's the internet, the steam engine, or AI, on the jobs market and the economy looking forward. Please remember to like and follow wherever you're listening or watching, and enjoy the show. We got good gain. We got good angles.
Yes.
Now we need some good market gains.
Right on.
Is that with a Z?
I don't know. Is that what the kids are doing these days?
I believe so. So we're good. You calling from home there, Carmine?
I am, yes. This is my my home office.
Okay.
The tree of life behind me.
There you go.
Yeah.
Did you have your cup of coffee this morning?
I am on my first cup right now.
Oh,
yeah.
first
cup. How many cups do you do a day?
It's interesting. It's like it winds up being, I think, I average about 4 a day.
Wow.
So a couple in the morning, and then that 2 to 3:30 stretch is usually where the other comes in.
Wow.
Yeah, and then if it's a weekend, you throw an espresso martini on there too. I'm not sure where that falls, but
I hear you on that. The espresso martinis are just more sophisticated Red Bull vodkas, right?
I think so.
We'll get into
the range.
We'll get into cocktails later. Just
Nice.
Teaser alert. So did you wake up, freshen up this morning extra early? I know.
I did. I just attacked the routine a little bit earlier. I mean, I'm on the morning get outside and move regardless of weather, unless it's like thunderstorms. But so I just dialed it up a little bit, and kudos to all the kids. They get on the buses really early.
They do.
So
They do. Yeah, I remember when I was in high school, I think I was getting up at 5 and on the bus a little bit before 6, like 5:45 or something crazy like that. I was the last stop. So I was the first one getting picked up, last one getting dropped off.
wow,
It's quite the journey.
That is early.
Yeah.
Big ask. Yeah. But it gets us ready for 8:30 in the AM podcast.
Here we go.
20 or so years later.
Yeah.
Here we go. Should we roll it?
Let's do it. Let's cue the music. So today we are thrilled to have Carmine D'Avino join us on this episode of Amplified Wealth. With over 25 years of experience in finance, he is a seasoned pro who knows the ins and outs of wealth management. He holds the prestigious Certified Financial Planner professional designation and is an active member of the Financial Planning Association. Carmine's journey in the industry began with a BS degree in finance from Susquehanna University, followed by completing the CFP education program at Fairleigh Dickinson University. Since then, he has dedicated his career to helping individuals and families preserve and grow their wealth. But Carmine's expertise doesn't stop with individual clients. He also works closely with many nonprofit organizations, helping them review operating budgets, diversify security donations, and design customized portfolios to meet their specific goals. One of his standout achievements was leading the firm's early adoption of exchange-traded funds in client portfolios back in 2002, well ahead of the industry trend. When he's not in the office, Carmine enjoys a rich personal life in Somerset County, New Jersey, where he lives with his wife and 3 sons. Carmine cherished coaching his kids in youth sports and now takes great joy in cheering them on from the stands. He has a passion for cooking and loves to travel, often finding peace and relaxation near the water. Welcome to the show, Carmine.
Welcome, Carmine. Cue the applause, Nick.
There you go.
There we go. Hello.
So, how old are your sons now, Carmine?
I now have about to turn 24, about to turn 23, and an 18-year-old. So my 2 older boys are 13 months apart, and both of them have now graduated college, and my youngest is about to graduate high school and enter college.
Okay.
So,
Were they all, did they all participate in athletics?
they did.
They did?
Yes.
What was their sport again? Is it lacrosse?
The two older boys were big into lacrosse and had very successful careers. The high school team won 2 state championships in 4 years while they were there.
Not to brag.
A lot of hard work, and
it is.
it was great lessons learned and great friendships made. Also,
yeah. So when you coached, were you coaching lacrosse, or was it a different sport?
I coached basketball.
Okay.
With all the boys up until kind of middle school, and then I let the professionals take over.
Sure.
So that was a fun ride, and again, it was about spending time with the kids, the windshield time, as it's known, and I'm a competitor at heart too. So it was fun for me to kind of get out there and not just teach kids. But also kind of just be part of the team myself to a degree. So it was a lot of fun. I think we all look back on it fondly, and it was a really rewarding experience.
So you're entering a new stage in your life coming up in the fall, an empty nester, right?
Yes and no. My son, my oldest son, when he graduated college, actually landed a really nice job here close by home, and he is living at home for the time being, saving some money for the last year and starting to, contemplate moving out with some friends. My middle son just graduated, is going to be looking at law school. So he is preparing for that. So yes and no. I think it's coming. I'm in no rush for it to happen overnight, but you can see the writing on the wall, and life is definitely evolving, and we are clearly entering another stage.
Yeah. Great.
Yeah, I mean, it's nice to have a parent that isn't kicking them out, I guess.
It's hard to kick them out, but if they were sitting around on the couch doing nothing all day, I mean, or playing video games, I might feel differently about it. But they are contributing to society in one way or another, and it's just helping them along. So they haven't fully been kind of launched out of the nest yet, but they're kind of on the edge.
Right. They say part of the, I guess, not what's wrong, but the experience in real estate today is that parents have become friends with their kids, as opposed to decades before where the parent was the disciplinarian, but now they're friends, and it's like, why would I want to leave my parents' house, right? I get my food taken care of, maybe laundry done. I'm hanging out with my 2 friends that are my roommates. They're great.
Yeah. Yeah, no, I think it's true. And I've tried to strike the right balance between, being a disciplinarian when you need to be, or at least having the heart to hearts, which, I think are too difficult if you're just acting like a friend all the time. So,
sure.
Yeah,
sure.
It's interesting, but it's, it's tough to perfect this thing called parenting. So you do the best you can, and, hopefully the kids respond to that and wind up to be successful.
Amen to that. Do the best you can.
Right.
Exactly.
And you don't know if you did it wrong or right until like 10 years later. So,
or more in some cases, right?
So the book on raising your kids changes every decade, I think, just because they realize, only 10 years later what they messed up and what they got right.
For sure. And we'll touch on technology today, but that's a big part of it too.
Yeah. And I think what you were saying about that balance between, being someone's friend, but then also having those hard truths, right, really resonates with today's conversation, right, with the isms and the things that we're going to talk about today.
Yeah, absolutely. I think we'll have some fun with today. I mean, it's about seasonality, isms, and how they can, distract investors from, really the fundamentals of investing and truly being an investor. So, as we exit May and enter June, I think it's, I think we'll have some fun with today.
Sure.
So
let's,
and with that said, I mean, here we are, one of the more notable kind of isms, sell in May and go away. And it really is a suggestion and an old adage that investors should sell their stocks in May and then re-enter the market in the fall. And just kind of thinking about this, Over the course of my career, I always initially just kind of took it as like the summer's a sloppy time for one reason or another. It has
vacations, the beach.
Volume. Yeah, exactly.
Low
Adults
volume,
leaving
right.
the room, or head traders, or lead analysts, slowing down a bit. But it is interesting to note that it dates back to the 1770s, and it dates back to England, where a lot of the bankers and folks that in charge of industry would leave the city in the hot summer months, and then they would return for a specific event. It was a horse race, actually, the St. Leger's Stakes horse event. 3-year-old thoroughbreds run in this event, and I believe it still occurs, to this day. So it's something that attracts people back to the city. So,
interesting. So there is a meaning behind it. It's not just summer.
And it also predates the U.S. stock market, right? I don't
Probably.
believe that there was a U.S. stock market back in the 1700s.
No, it doesn't. So, but Wall Street is kind of it's steeped in history and these old adages and isms, and that's always kind of been an intriguing one. And truth be told, it doesn't stick around. It doesn't last this long unless it happened at some point in time, or there is some form of validity to it. But I think if you have a wider window or take a look at things over a longer time span, you'll see that you would have been better off just staying in the markets the entire time, instead of just saying, this is my investing strategy. I will be in the markets or in investments through May, and then, just sit in cash for a few months until, the fall.
I feel like even if it works just once, but really well, then people are going to remember that. Right. And even if over time, it hits that 1 out of 10, like a roulette wheel or something. And I know I'm leading on a little bit, but, it sticks with people. Right. Yeah. So I think back to 2008, we've got a chart up here, which hopefully you can walk us through, just showing what your returns would be if you just bought and hold since, the history of the S&P 500, versus if you actually sold in May and bought back in this example, it's November. But 2008 would have been an awesome time to be out of the market, right? October of 2008 was, hellish for the market. One of the worst periods ever, one of the worst months ever for the market. So, as long as you have those instances where it does work really well for people, they're going to hang on to it. And obviously the media tends to perpetrate this a lot.
They definitely do. We hear about it every May. You guys know CNBC is on it in May, and
Right. Do you sell April 30th? Do you sell May 1st? Do you sell halfway through the month? When do you get back in? Do you get back in September, October, November? I mean, it's really just kind of hogwash at the end of the day.
Right on. I think the other thing too, if you think historically, a lot of the major market corrections, or some of the big ones that people remember, 87, these sort of things kind of happened in the fall. So that is just, again, as to your point, more fuel for this thing to keep living for a period of time.
Yeah.
But Wall Street's a very creative place, as you guys know. So there are a lot of these. The January effect is kind of a play on, if you're back into May. If you're back in the fall, the seasonality towards the back end of the year. There's another one that we're not featuring here on this slide, but the Santa Claus rally is another one that's very well known. The seasonality, the markets, tend to, in many cases, finish the year strong. In 2023, just 1 year ago, if you think about it, a lot of these probably held pretty true. I mean, the market started off pretty well in 23. It was a good comeback from what we experienced in 22. For all intents and purposes, kind of treaded water a little bit, during some of those middle months. And then in October, and tied to some of the messaging from the Fed in anticipation that maybe they would stop raising rates and be close to cutting, we did see a pretty strong rally in the back portion of the year.
Yeah, it wasn't like May and June last year. That was the whole AI hype phase where the market took off, right? We had the banking crisis in March.
Spring, right?
Yeah. And then the market kind of hovered around for a bit, but then really took off over the summer months.
Which, by the way, had nothing to do with which month we were in. Right. I think this rises to correlation versus causation, right? There's a difference between, whether something's correlated or whether there's causation there. Just because there might be a high correlation between two variables doesn't mean that there's a direct link between one variable and the other. Said another way, it doesn't mean that one variable causes the other to move. Right. So, in preparation for this, I looked up some examples of that, and I came across this one, that the total number of measles cases in the U.S. each year is heavily correlated to the declining U.S. marriage rate. And now, obviously, one doesn't, measles isn't causing the marriage rate to come down, right? But
I would hope not.
Right. The two what's moving the two variables is actually independent. We have modern medicine bringing the measles rate down, and then we have all these other variables or reasons that are causing the marriage rate to come down. But, if you were to look at them just on their own, you may be able to say, well, there's some predictive power here.
Yeah. I took a look at what monthly returns are, going back to 1950. If you just broke out the average returns month over month, May is actually positive on average 0.2%. June, 0.1%. July is actually positive 1.3%. It's one of the better months out of the year from a return perspective. August is slightly negative, believe it or not, but virtually flat. And September is really the only meaningfully negative month at 0.7% on average since the 50s, if you look at just September returns. So, maybe there's some truth to sell on August 31st and buy back in on September 30th, but I don't think that's something we're going to be recommending, unless, of course, you have, for whatever reason, zero capital gains that you have to worry about, right? I mean, there's so many more factors that go into this other than just selling in May and going away. And this year, May was the best month yet for the stock market, up 4.94% on the S&P 500. So, and then what do you do, right? The alternatives. Okay, do you hold cash? Do you go into a treasury bill? What if your treasury bill, or do you go into bonds? Do you sell your bonds? There's just so much wrong with the saying of simply sell in May and go away. It's interesting that it's honestly stuck around this long.
Yeah. I think the same could be said about most of these isms. I mean, if you look hard enough, you'll find examples of where it worked and you're like, aha, right? But, if you think back to what was going on in that particular time, there's always another explanation. I don't think it's just the seasonality. The Santa Claus rally, which leads into the January effect, which is, this other item that we've highlighted here, indicating that, there's a belief that how the first week of January or the month of January go, so goes the market. But in some years, especially good years, it's new money entering the markets in that time frame where people are comfortable allocating their bonuses that they've received during the fourth quarter, or anticipating maybe needing a little less for a tax liability. So therefore kind of holding back a little less of what may have been set aside for taxes, in preparation for the April filing deadline. But again, I think if you look at it over longer time frames, what we're able to see is that you were better off just kind of sticking to the appropriate plan for you, as opposed to, looking at this as a trading strategy. It might be a trading strategy and one that kind of works a lot less than people may anticipate, but it's by no means an investing strategy, I don't believe.
Right. Well, what I like about what you have up here on the screen for the January effect is it describes that, if the first month, right? So the predictive power of the market's direction based on the first month returns in January is 77% correct, right? So 77% of the time, it's good at predicting how the rest of the year is going to happen. And if you were to be invested, right, and these are long time periods, right, but from 1928 on, $1,000 in the Dow Jones Industrial Average, by following that strategy, you would have made $5 million off of your 1,000, right? But your opportunity cost, right, what you gave up by being out of the market when when the signal said to be out of the market, you would have gave up $3.3 million, which is a big number considering that you made 5, you gave up 3.3. Making 8.3 is a lot better, obviously, than making your 5. But even though it works, and even though I like the odds of it being 77% correct, right, you're still giving up something, right? By following.
Yeah. And I think what you're giving up is the possibility of being in the market for some of its best days. And, I think if we look at the next slide, which is pretty powerful, you really can quantify how much you lose by just missing a handful of days, which nobody can predict when these days are coming, and whether they come in succession or not. But, right, this particular one, demonstrates with $1,000 original investment, what it could turn to if you were invested over, an entire time frame. And here, this example looks at, January of 2010 through December of 2019. So with $1,000 becomes $2,897 if you're in the entire time.
If you don't do anything, right? You just buy and hold.
Yeah, if you just buy and hold, yeah. If you miss just the 10 best days in that time frame, I mean, you missed out on 33% of the return. It's just 10 days. If you miss the 20 best days, you've lost half the return. So instead of 2,800, you wind up with 1,400. It just gets worse if you miss, more days. So, Adam, earlier you're joking, do you get back in on this day or that day? I mean, that's the real tricky part of the equation and the decision. So,
right. I think you have to appreciate how many days we're talking about too. I mean, we're talking about 9 years of data. I think there's a little over 250 trading days in a year. Let's call it 250. 10 years would have been 2,500. So we're only 9 years. So 2,250 days. There's 2,250 trading days. If you just miss 10 of those 2,250 days, your return is 33% less, right? Even if you missed the 40 best days, which brought your return down almost 70%, 40 days out of 2,250 days, that's less than 2% of the time. If you're out of the market less than 2% of the time, and you happen to catch, these bad these best days, then your return is more than cut in half. It's actually kind of mind blowing to think about.
This is all psychological too. I love this. The Dalbar group did a study on this through the early 2000s. That's very popular. And the numbers are always the same. People have repeated this strategy over every decade, pretty much. 10-year periods, 20-year periods. It's always the same. And if you actually look at where those 10 best days occurred, you will see that they occurred within a week, most of them, from some of the worst days in that time period. Okay. So let me say that again. The best days occurred within a week of some of the worst days for the most part.
Right.
So why would someone get out of the market? There's obvious reasons why you might sell, whatever. I need money for a house or whatever it is. I have bills to pay. But if you are timing the market, which is what this comes down to, and you're selling because you're scared or you foresee bad things happening, you have to recognize that some of those best days could be right around the time period when some of the worst days are happening.
Right. And how many people have it in them to go through a worse day and then go in and immediately invest? A lot of people, once they see those they see those major drawdowns, that just makes them more scared. That makes them less likely to buy into the market.
100%. It always gets worse. It always gets worse, right? No, the market is forward looking. The market is discounting every bit of known information that you think is going into the pricing of the market. The market's already considered it 5 times over.
And I think, the viewpoint that we stress to clients, throughout the year and years is that, we come up with a well thought out plan. It can be adjusted. It is fluid, but sticking to that plan is really what delivers the best returns and best experience, quite frankly, over time. We don't look at this as gambling. We don't like to have these gambling conversations with clients, but, especially in certain market environments. And I see a little bit of it today with this, resurgence in these meme stocks and what's going on with, GameStop in particular. It's this gambling mentality, because it's not really based on fundamentals. So it will end pretty badly for a lot of people. And we just want to help our clients kind of avoid, some of those mistakes.
Well, I think the important thing is to understand that your asset allocation is working for you and your goals, right? So if you know that a big market drawdown is going to cause you to sell and miss some of the best days, which could be close thereafter from the worst days, don't have as much in stocks, right? Build out that plan, build out that diversified portfolio with your advisor, and do things that won't cause you to stress when times get bad.
Right. Yeah. Because this isn't gambling, which I think is a good prelude to the next slide that kind of help us quantify this. And this is interesting. I mean, I live in New Jersey. We have a couple of casinos, nearby, and I don't frequent them. I'm not a gambler, but it is kind of fun just to stand at tables and watch, if nothing else. But this I think is an entertaining and informative slide in that it shows what your odds of winning are. And as many people have, said or Baccarat is the odds are, fairly good, relatively speaking. Craps another kind of decent one, as is, backgammon. You have about, a 48% chance of winning as a gambler. The odds at Keno, not really sure what Keno is, to be honest with you, not quite as favorable. But, there are slots probably, along the bottom there too at about 40% chance.
Right.
Where you compare
Isn't Keno a Massachusetts game, Adam? Is that, or is that Rhode Island?
I think it's somewhere around here. I know in like convenience stores, you can pick up, just like you can pick up lottery tickets, right? You can, like in train stations and stuff like that, they have Keno, right, where you can just like fill out some numbers and it's always being played and shown on the TV. I don't know. I think it's a cross between I'm going to probably sound way out of my element here. And Nick, we're going to need some editing magic if I'm completely wrong, but I think it's like a cross between the lottery and like bingo, where you have to get a sequence of numbers correct in some order. But
right. But your odds are only 23%. There's 23% chance of winning, right? And I think Baccarat, which I actually, to be honest, I'm not even sure how to play Baccarat. That's your highest odds at 48.8% chance.
Well, maybe the payout's bigger with Keno, right? So like blackjack, you bet what you're willing to lose, and then you win what you bet. But maybe with Keno, there's a 23% chance of winning, but if you hit, you win 4-1, right? I don't know. So there's still a house edge either way. And the point I think Carmine's trying to get to is, is this rigged, right? Is it rigged against us?
Right. Sorry about that, Carmine. You were clicking and I disrupted you. I will, I'll take a step away.
No worries.
Why don't we discuss the logistics of casino games over, we can go down to Atlantic City or something like that, right?
Let's try all these out ourselves. Let's work our way around the wheel and see what our experience
We'll debate that. How about for the market podcast, we talk about how it relates to the market?
There you go. Well, I'm actually surprised because I knew blackjack and craps were up there. Blackjack at 48% probability of winning, craps at 48.6%, but this game Baccarat came out of nowhere. I have to look that up.
That's very popular. I believe it's very popular in Asia from my travels to Macau. But it's
interesting. Yeah. So I mean, those are the odds for gambling, but you kind of compare that or contrast it to investing, and I think this is it's powerful. I mean, you are compensated for the risk that you take in the markets, and the longer you're in, the higher your odds of quote unquote winning are. The percentage of years the U.S. stocks, as measured by the Dow, posted positive returns over rolling periods. Again, a long time frame, 1901 to 1923. These odds are much higher. I mean, we're 72.8%, 73%. You don't even see that on the gambling portion and being anywhere near those sort of odds, but 73% of the time over a 1 year period, you have a positive return.
Yeah. So just to clarify, this is rolling time frames on a monthly basis. It's not calendar year returns, right? So you're not saying 73% of calendar years were positive. What we're saying is pick any month, February of 19, whatever, 54, there's a 73% chance that the next 12-month period, that 1 year, is going to be positive. So I think this is powerful. It takes out the timing aspect of things. You don't have to start investing in January. You can start and put your money into the market anytime, but there's a very high likelihood that you're going to be positive over a year.
Yeah. 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 And that's the point, right? So we always talk about this plan and sticking to an appropriate plan for you, given where you are in life. And, it's not so much about timing. And we talk about this. I know the three of us have talked about this numerous times, not about timing the market, but time in the market and, kind of being rewarded for, the risk that you do take as an investor, because there are those ugly times. And, we've talked about a few of them, but, 2022 wasn't that long ago, in a difficult year. But look at what happened in 23 and thus far into 24. So
I think that's one of those. I think that's one of those isms that I can get behind. It's not about timing the market; it's about time in the market. Because that 1 year rolling time frame, 73%, those are good odds. It's more likely than not, right? But as you extend this out, as the chart we're looking at for listeners, as you expand your time horizon, right? So over 3 year periods is actually closer to 86+% that you're going to be positive. Over 5 year periods, it extends up almost to 93% of the time you're going to be positive. 10 years, 97.5. And, once you hit 15 years, it's a 99.9% observation rate of being positive over those 15 year periods. Powerful.
Right. Now, to bring it back to the previous slide, though, if you're market timing, those aren't your odds. Those are your odds if you stay invested the whole time, right?
Yes. So, I think the next slide is very interesting that you brought, Carmine, but, kind of for the people that do think something's rigged or it's gambling, right? For those folks, I think this next slide really does a wonder and the meaning behind it really does a wonder of debunking that myth.
Yes, because there is something that stocks trade on, and stocks perform well when the fundamentals are good. And, this chart just kind of demonstrates the correlation of, stocks do trade on fundamentals more than anything else. There's no doubt, I think, that, the market it's humans to a large degree, and machines now more so than ever, that are kind of, invested or, making decisions in certain portfolios. But stocks themselves really kind of trade on earnings and fundamentals more than anything else. That you'll have certain time frames where that might be skewed for a short period, where kind of greed and fear take over, which are two other really powerful and pervasive emotions in the markets. But, it really always kind of comes back to, what am I paying for $1 of a company's earnings? Are those earnings real? Are they sustainable? Are they growing? Are they contracting? And that's really what drives how investments perform, especially stocks. So
right.
I think it was important to show that correlation is really strong at 0.97% of earnings to market performance.
Right. Where a correlation of 1 is a perfect correlation, right? That means they move together, right? At 0.97, that's
virtually
as high as, that's virtually 1. And I think, there's a lot to say here, right? These are real companies with real earnings, right? They're not just ticker symbols. I think a lot of people look at the stock market as just ticker symbols on a screen, right? No, these are real companies with real earnings. And, you talk about the titans of business that made their wealth from starting a company, the Bill Gates, the Jeff Bezos, the Mark Zuckerbergs, Larry Ellisons. Some of our listeners are successful business owners. They didn't get where they are today by trading in and out of their company, right? Mm-hmm. They got there by creating a quality business and then staying invested and allowing that company to grow over time. Right. You think about some people's mentality of jumping in and out of the market. Well, if you had your own quality business, would you be selling your business when you thought it wasn't a good time and then buying it back when you thought it was a better? Probably not. You'd stay invested.
Right. Right. Or you could really luck out and do the opposite, which is like, Dave Portnoy. But, he's one example. But, you sell your franchise for hundreds of millions of dollars and see it mismanaged. And then, the person you sold it to is selling it for, I won't say pennies on the dollar, but at a significant decline. So you buy it back and kind of do the whole thing all over again.
It's true.
But, again, I think, he knew the power of the brand and what they could achieve and how to manage it and get those earnings back up and growing. So,
right. And he got lucky with that. He got, part of it I think is luck. Part of it is, he knew what the business was worth and that it was trading at, a valuation that was below what he thought it should be at, and he was willing to pick it up again.
And I think it's important to differentiate between the type of correlation Austin talked about earlier with the measles and the marriage, right? That's
right.
Not causality, right?
Yeah.
There is causation here because the stock prices do reflect the fundamentals of the companies, or they're meant to reflect to some degree, right? So this very strong correlation is due to causation. I want to be very clear about that.
Right. And if you think about it, we're living in this society where we have a stock market linked to it. As long as our society keeps growing, as long as our technology keeps getting better to make businesses more efficient, the market in and of itself needs to go up in price. Because as there's more people out there buying goods, well, there needs to be more companies to buy those goods from, right? There needs to be more goods to buy. As long as technology is getting more efficient, that's going to increase the margins of our businesses or make it easier for them to expand and things like that. So as long as our world doesn't fall apart, the stock market, doesn't fall apart forever, the stock market shouldn't fall apart forever. So that's why, in having these plans, investing for the long term makes sense, and why that, 99.9% of the time the market's up over 15 years is reflective of the fact that our population keeps growing, our technology keeps getting better, which means companies need to grow.
Yeah. And I think that's kind of it's a good segue to where I want to focus next, if we could, which is, that volatility. And it's not always roses. I mean, again, we talk about these rolling time frames and staying in, but there's a lot of agita. There's a lot of unease that can occur, in the markets. And, maybe we are setting up for some here, as we enter June of 2024. I mean, think back to 2023, great comeback year, first few months of 24. There's a lot baked into the cake. Some folks would argue that the Fed should be cutting rates by now. The market was rallying because, there was this view that rates would start to be heading lower. And we haven't seen that yet. Maybe inflation's a little stickier. So, I don't think it's out of the question to think, in this particular year, maybe we do see a little bit of a pick up in volatility in these summer months for some of the reasons that we attribute to the seasonality, the lower volatility. The lower liquidity. So therefore, you don't need as much and as many participants to move the needle. I mean, if there are fewer participants in general and they're all more tend to be on the downside or sell side, then you might see a little bit more downside volatility. But, we'll see. But I think it's good to kind of remind people that, there's no free lunch. And, while those rolling period returns looked really good in terms of having a positive outcome, there is some potential discomfort along the way. This next slide we show is kind of, market returns and also the intra-year volatility of those returns, year by year, going back to 1989 through 2023. What it demonstrates is the high point and the low point of a market in a calendar year, and then where the market finishes on December 31st, right? So we're used to kind of measuring things on this calendar year. Although, Adams, you pointed out reality, it's not everyone starts investing on January 1st and finishes on December 31st. But on a calendar year basis, this is very powerful because it shows, in certain years, like in 2013, the market was down as much as 6% at some point during January and December, but finished up 32%.
Right.
In the following year, you had kind of a similar pattern whereby at a low point, the market had pulled back 7%, and then, finished the year up 14. So
yeah, 1998 is always the year I gravitate to on this chart. We had a 19% drawdown at some, in the middle of the year. I believe it was, the summer fall months actually. While we're on this topic, with this sort of Asian contagion that went on there with the currency crisis, and but the year finished 29% positively. So years can be very volatile. And, despite being usually positive, they can still have a lot of volatility within that positivity.
Yeah. And I think it's a surprise where you don't see this, negative figure at some point during the year, where you don't see kind of, the pullback. 2017 was, kind of a pretty tranquil year to a certain degree. I mean, it was down 3% at its low and finished up, 22%.
Now, this is not, it was down 3% at some point in the year. This is just saying that from at any point, we saw a 3% pullback. That was decline. the most decline, the biggest decline that we saw throughout the year. So, the average or the median they're using here of total return since 89 in any calendar year is 14.5%. But the median decline at some point in that year from, peak to trough was 10%. So you're going to, most years you can expect 5 to 15% volatility at some point in the year.
Right. And 10% down 15% is a correction, right? So 10% is not that far off from it. So, that's the price you pay for the great long-term returns of being an equity investor. Is you need to be willing to ride that 5 to 15% down in any one given year and hold on strong for, those outsized returns over the long term. I had a client who said, I told you so when the market fell 5% in April. And I didn't really have a response back because I was like, yeah. And then I probably agreed with you, because at any given year, the market can fall 5 to 15%. The market has, rebounded since then. But that's, as an equity investor, that's what you're signing up for. That's what you need to prepare your mind for, because if, you start to invest or you get panicky when the market sells off, right, you're not going to ride up those good returns. You're not going to get the good long-term returns if you keep panicking and trying to buy in and out of the market.
So Fidelity ran a study, and this is one of my favorite, forgive me for anyone who's heard it before from me or on a podcast, but Fidelity ran a study through the 2000 decade. Okay. So from 2000 to 2010, they have a ton of accounts, custodial accounts that they manage, and they know everything about the people who sign up for these accounts. They know their age, race, sex, everything. Right. So they wanted to know, okay, like income, job, college, they know everything about people via the Patriot Act. So they wanted to run a study and say, what is it about investors that yields the best returns? Is it because you're older and you have more experience, or maybe it's because you're younger, or maybe it's due to your employment industry, or whatever it was, right? So they analyzed the holding period returns of all of their clients. And then, they looked at all the attributes, and there was only one thing that consistently led to better returns. And it was actually that the clients of those accounts with better returns were deceased. They were dead. Right. They literally couldn't have any emotions.
The key to investment is success.
They literally couldn't change anything about their portfolio. So the moral of the story here is really the best thing we could do as investors is put our money into the market and forget our passwords, right? I mean, like, not look at this stuff. And this chart is just a perfect example. If you told me that in 1998, the market would be up 30%, well, I just shouldn't be looking at it, right? But I'm going to be really scared if you tell me that there's going to be a 20% correction at some point in the year. I'm going to be looking out for it. I'm probably going to be trying to time it. I'm probably going to be, cherry picking when I put my money into the market. So this all comes back to emotions and building a strategy that you can properly diversify and you're comfortable with.
And I believe that study was blind to how they were invested, right? They didn't care if you were invested in growth or value or small cap or large cap, right? So that's to me is more of the interesting part, because you have all these different types of investors, right, who ended up dying, right? But some of them are value investors, some of them are growth, some of them are large cap, some of them are small cap, some of them are mid cap, some of them are international.
It's just about the time.
The key to success was just not touching it, like sticking with your strategy. And they stuck with it because unfortunately they passed away. But, I think that says a lot, right? There's all these arguments of, well, what's better? What, should we hop into be value now and then gravitate towards growth as certain things change? Well, maybe the key is just don't touch it, right? Have a disciplined strategy and let it go.
Yeah, right.
I think that's one of the biggest roles we can play as advisors too, is, being that emotional coach, that counselor, if you will, for our clients to, prevent them from making these mistakes.
No question. There's no question about it. And I do think that when volatility picks up and, you're in that part of the year where the market is pulled back 6 to 20%, those tend to be the conversations that we're having with clients, is reconfirming, why the portfolio is set up as it is. Reconfirming, is that still appropriate? Reconfirming, has anything changed that would warrant us to, make a decisive or, measurable modification to the portfolio. And if at the end of those conversations, it's really like, no, it's just that I'm nervous and, I needed some hand holding. I mean, that is a big part of, what we play. That role is a big part of what we play. But, Right. Most of it is about getting the portfolio constructed properly to begin with, and then, kind of going into that proposition with the understanding that you're going to see some less than pleasant timeframes in the markets. I think the next slide is really important too, because it helps demonstrate that while there are these less than favorable timeframes that are oftentimes referred to as bear markets, they do exist. They are very real. The good news is they tend to be a lot shorter in duration than bull markets, or when the markets are, going up in value. Most recently, we came out of about an 11-year bull market starting at the end of the financial crisis of 08, 09, and, kind of brought us up to the point where, we kind of had to battle through the pandemic and the market panic, a reaction to what was going on there. But this slide for the listeners goes back to 1942 and demonstrates the duration of the bull markets. It indicates the timing of the bear markets and how long that they lasted. What I can say is anybody who isn't able to see these is that it's striking in the fact that the bull markets tend to last a lot longer than the bear markets, and the returns to the upside are really nice, especially relative to most bear markets. Which, yes, the markets are going down for a period of time, but the drawdowns relative to what you capture on the upside by being in and participating in the bull markets, become less significant.
Right. So
the blue color is showing bull markets. The orange or gold color is showing bear markets, and the vast color on here is blue. Right. There's a lot of blue. There's just specks of that gold. So visually, it shows you that while a lot of people spend a lot of time focusing on the bear market, when's the next bear market or the pain of the last bear market, majority of the time we're spending it in a bull market, and those bulls tend to be stronger than the bear markets.
Right. And this goes back to 1942. I have the updated numbers as of March, the end of Q1 2024 this year. The bull market average lasts 4.2 years. The bear market lasts on average 11.1 months. Okay. And the average returns there, we're talking about much more blue on the screen. The average returns is 148.9% for the bull markets positively. So more than doubling on average. And then a bear market is seeing a 31.7% contraction on average.
That's the real deal. That's the rubber meeting the road and how things have really played out.
Yeah. I mean, if you told me every fifth year there's going to be a really bad year and I'm going to lose a third of my value, I'd kind of, I might balk at that. Right. But if you tell people the flip side, that after that happens, you're going to have 4 great years where you more than double your money, you can quickly do some back of the envelope calculations that should grow over time.
And so, I included the next slide, and I don't want to spend a ton of time on it, but we do find ourselves kind of, sniffing all new all-time highs. And, I think that in conversations with clients or, even amongst ourselves, it's good to kind of remember that, just because we're at highs, it doesn't mean that, we're not going to make a new high. I mean, over time, there will be a new high. There could be a significant time frame between those new highs, but history shows, again, the graph that we have up or the chart that we have up for those that are listening is that, the market has seen over 1,100, new highs since 1957. So I don't think it's a good thought process to say, let's not invest because the markets are at highs or at new highs. I think you can have a grown-up conversation and a good debate about whether you go all in or get all out, at highs. And that's kind of a different conversation, although it does rhyme with this discussion on timing. Mm-hmm. I don't think you should be put off by the markets being at, highs, especially, again, if the fundamentals remain reasonable. The outlook is somewhat favorable, the current valuation's reasonable, and you're investing in companies that are able to continue to operate and navigate whatever the environment is at that time. So that's really, I think, what drives how you should be considering getting into the market. I mean, maybe you don't want to be getting into the most highly valued companies at these highs. There's a ton of good news baked into them. But there's a lot of really good companies that are trading at very modest valuations, firing on all cylinders in this environment and well positioned to even do well if this environment slows down some, like, GDP or economic growth. So, I don't know how you guys feel about this concept, but I think it's important.
Oh, definitely. I mean, we've looked at research on this, and you're actually better off investing at highs, only investing at highs, and then holding it for a year or holding it for 2 or 3 years and then getting out and then waiting for the next high and doing it again. You're better off investing at highs than you are not investing at highs, or staying invested the whole time, right?
All-time highs tend to follow more all-time highs.
Strength begets strength.
Yeah.
Yep.
Yeah.
I think it's interesting. A lot of these, you can, for the viewers, you can see on the chart there's a bunch of dashes, through the 80s and 90s. A bunch of dashes really started after the 08. We got above the 08 highs.
With each dash being a new high, right?
With each dash being a new high, into 2013 and beyond. We've been setting new highs pretty much every year since 2013, with a few exceptions. You think back and there's sort of these, and talk of secular bull markets, right? We could be in the middle of one now. It could be coming to an end. We don't know. But if we are going to see, another 4, 5, 10 years possibly of periodic new highs, even if we're not, why would you take that risk that we might, right? I think that's what it comes down to for a lot of people. Right. And understanding what's your long-term money and what money are you going to need more stability out of, right? Properly diversifying so that you can leave the money that has much longer term time horizons growing for a lot longer.
Yeah, no, I agree. I think that the next chart too, just kind of, it shows too that over time you're going to have some dips. We're going to contend with some things. Every generation has and will continue to contend with some things, but it doesn't mean that, the game is over. We can't invest anymore. But this next slide, I thought was, from a historical perspective, meaningful to me because, we get to remember things like world wars. I mean, we as a country and really as a world have gone through some pretty nasty things. World wars and what that's done to, beyond the markets. I mean, people, civilizations. But we tend to kind of come back from this. And, it's interesting, in this country, this is an election year. We're going to touch on that a little bit. But, President Kennedy was assassinated in the 60s. And although I wasn't here during that time frame, just being interested in history, it's very interesting to kind of go back and look at what people's mindsets were and put yourself in the shoes of how the country must have felt when you lost a really kind of beloved leader at the time. More recently, we've gone through the tech wreck. We lived that, real life here at the firm and guiding clients through that. The terrorist attacks of 2001, the Great Recession, again, the financial crisis, still recall that vividly. And I've saved my newspapers from the Wall Street Journal and New York Times from those days and kind of preserve them in my own personal museum, if you will.
That's great.
Just we're going to continue to see some things now. And clearly over the last number of months, we've seen some more global unrest and some unrest here in this country on college campuses in particular. It's part of what kind of filters into the news cycle for sure, a little bit into the markets. But, this also plays into another adage, which is the markets tend to climb a wall of worry.
Right.
Mm-hmm. There's always some things to worry about. And I actually kind of prefer it that way. And it's a little bit of a contrarian statement. But if everyone is in love with something, that is alarming to me, and at least a red flag. I mean, if everyone's in love with stocks or everyone's in love with the markets, I think that's when, at least over the course of my career, I've learned that you want to start to look at what the opportunities are away from where everyone is looking, simply because I think that those areas aren't being paid enough attention to. And maybe that's where there's more opportunity instead of continuing to pile into, let's say, the Mag 7 or whatever the current name is for that small group of market leadership. I think a few of the 7 have dropped off, in 24, but that thought process is the same. And I think just putting things in perspective, keeping things in perspective is very important. And that's why I wanted to share this too. So.
Right. I feel like if the stock market was a person and they heard people talking about that next worry, well, aren't you worried about this? Aren't you worried about that? The stock market would look at them and say, hold my beer, and show them this and show them what it's been through, right? It's been through world wars, presidents getting killed, the banking system blowing up. And you know what? It's persevered. And I think that does say a lot.
Yeah. It makes you wonder what's next, right? There's going to be some big, bad, ugly news story that comes out that's going to try and throw us off.
It is. And I love that. It's what's next. But if you have a good plan in place, if you have, buffers in place and you have some level of protection, it should be less of a concern. I mean, it's not to say that you're not going to get nicked. The portfolio is not going to participate in some of the drawdown, but what we talk to clients a lot about is if we can protect on the downside somewhat, we've got less to make up when the markets do eventually recover. And we're never going to profess to be smart enough to know when that turnaround will occur. But I think we've already looked at some slides here to demonstrate that historically that recovery will occur.
And there's certain types of investments and asset classes and sectors that do well in times of crisis, right? Consumer staples, everyone still needs to buy toilet paper, even if there's a pandemic or, a terrorist attack or whatever it might be. U.S. Treasuries, right, in a time of panic, it can be a source of safety and get bid up and see the yields come down. So, there's different ebbs and flows within a portfolio that can, with proper management, can be really well built to do well when times are good and have those buffers in place when things get bad and rocky and shaky.
That's right. And I think that's a great segue to asset allocation. And really, we're going to talk on, we'll touch on two things here with regards to asset allocation. But this is it's somewhat of a simplistic way of looking at it, but it's very effective. I mean, basically, it kind of shows that if you build a diversified portfolio, and this is, again, not to get too deep into the weeds, but it's a balanced portfolio. 60% of global equity exposure, 40% of fixed income exposure. And you look at the year-by-year returns of where that portfolio lands, between 2013 and 2023. The interesting thing is it's never the best performer. It's also never the worst performer. Right. So that's key. I mean, it's not about, picking what's going to do best and being completely in that category, because that's impossible. I mean, if anyone were able to figure that out, it would probably be the richest person in the world and, own multiple private islands. So, again, it's interesting, like in 2022, 2023, master limited partnerships were, the best performing class. But,
go figure, weren't energy stocks up like 100% that year as well, right?
Yeah, that leads to it. But go back a couple of years and you were scraping the bottom of the barrel in 2019 and 2020. They were the worst.
Right.
So it's impossible. But if you have a diversified allocation that's appropriate for you, again, not saying 60-40 is appropriate for most people or anyone, but it's a fair balance between the two major asset classes, and it kind of shows that you're definitely in the game and towards the top third of returns available in the universe, most years. So
I think, and I think you have to understand that if you do want to take on more risk, you have to be more comfortable with, letting time take its turn and play out over many years, because, some of these names at the bottom can also be at the top in many years. And you have to be okay with that volatility if you're seeking outsized returns, right?
Yeah.
The volatility is sort of the price we pay. The risk is the price we pay for good and better returns over time. So, you can have stability or you can have volatility, I think, but those can lead to different return profiles as well.
Right.
You can't have good returns and no volatility, in other words. At least that I know of. If anyone is listening and knows of something, please
I think Bernie
DM
Madoff,
me after the show.
I think Bernie Madoff was able to accomplish that.
Oh, fair enough.
But yes, we all know where that landed him.
Right.
So.
Right. Yeah. And then I think, we would be probably chastised by someone if we didn't highlight or at least mention the next study, which is just, greater confirmation of the importance of asset allocation. And Adam, you spoke earlier about the Fidelity study. Well, Mr. Brinson, Mr. Hood, and Biebauer did a similar sort of study, which showed that, most successful investors, the reason behind it wasn't necessarily that they picked Apple over Netflix or vice versa. It was, their asset allocation really kind of drove their experience and their return. So market timing was actually the smallest component of success at less than 2%. So right. It's just interesting. It's academic, but it's worth kind of just mentioning here that that asset allocation really is the most important driver of the experience. And
right.
This backs up a sort of a top-down approach to investing, right? So,
yes.
Are you in stocks or are you in cash or are you in bonds? Let's start there. And then if you tell me the answer to that question, I can give you a pretty good likelihood of what your return profile might be. And then, if you say I'm all in stocks, okay, well, are you in large cap or small cap? Are you in US stocks or foreign stocks? Are you in tech stocks, or are you in consumer goods, right? I can give you a better idea of what your return profile is going to look like over time. And then, you can drill down even further within that, let's say technology, and, are you holding Microsoft? Or are you holding, a cybersecurity company, right? Those are going to have different profiles as well.
Right.
And, but they will be very similar, right? So tech stocks and consumer stocks are going to behave a lot more similarly than tech stocks and cash will. And then, Apple and Microsoft are going to perform over time very similarly to other tech stocks as well,
right.
But very differently than other asset classes or other sectors potentially.
Right. And I think it's eye-opening for those that spend a lot of time on security selection, on trying to get the next best stock. The question I think they should be asking themselves is, you doing that because it's fun or because it makes sense? Because that's what's important. If you look at the studies, it's not what's important, so it must be because it's what's fun. And do you really want to take your life savings and what you're depending your retirement on, or what you plan on giving to that next generation, and have fun with it? Or do you want to do something disciplined that makes sense? And I think the discipline that makes sense, I think for most people would override the fun aspect of it. And we're not saying that you shouldn't have fun, right? We have plenty of clients, and even myself, you take a sliver of your wealth and use that as your play money. But then the vast majority of it, right? You want it to grow intelligently. And what this is telling us is that asset allocation is the reason for 90% of why a portfolio acts the way it acts. And that's what makes the most sense for us to spend the most time on as investment advisors, people building a portfolio.
Yeah. And I think, that's kind of a good summary for really our core tenets and beliefs. And I hope that we put together some information here that shows it's fun to pay attention to the isms, but I don't think you want to be distracted by them or use them as an investment strategy. Rather, just kind of look at them as Wall Street folklore and history, and they'll work sometimes and most times not. But they're there. But it's fun to talk about them for sure.
Right.
So,
I know. I know you wanted to talk about the election, right? We are definitely. We covered this a bit too in I want to do a selfish plug here for our economic quarterly webinar, an investment seminar that we put together. But I do want to dive deeper into this. So tell us what we've got next.
Yeah, so it's not necessarily about the election, but since we're talking about isms and we've touched a little bit on history, and we know with the time that we're in now, and it's super contentious. But I thought, if anything, I would just highlight the fact that, hey, it's been really contentious historically speaking. And,
right. Biden and Trump haven't killed each other yet, right?
Not yet, but, I think.
Well, I say yet and laugh sheepishly, but
I know.
It's happened before.
we all know Alexander Hamilton. Present on the $10 bill, he was killed. So he was actually killed in a duel. Yeah. So right. He and
Aaron Burr
had a contentious relationship, and it boiled into a duel that they actually had in Weehawken, New Jersey. Mm-hmm. And Alexander Hamilton was shot in the abdomen by Mr. Burr, and they took him across the Hudson to present-day Greenwich Village for treatment, but he did not survive. So I didn't realize it until I started kind of diving into some of this, but that is how Alexander Hamilton passed away.
Oh yeah.
Right.
So we're not there today, but just historically speaking, that has occurred. And what happens a lot today is, the media and social media has been involved in, throughout the pandemic. Their prominence has grown, and then in this political arena. And it's just interesting to see that, even back in the days of George Washington and Thomas Jefferson, they kind of had similar feelings about quote unquote fake news. At that time frame is, really about what was being featured in the publications, the newspapers. But this is not a new phenomenon. It doesn't make it less. It doesn't make it easier to deal with today. But this is something that has been in play for quite some time. So as contentious as it is now, again, you think back to that other chart that we looked at, which is kind of, each generation faces their own hurdles. Some of this is not new news.
Right.
These two quotes. Do you want to read these, Austin?
Well, I was going to say that going back to the other slide, this happened, right? And the market said, "Hold my beer," and it did great in spite of it, right? The market didn't collapse, right? It still did. It still has done wonderfully since. I think he died in the very early 1800s. It's still done magnificently since then.
Right. George Washington. This quote: "Newspapers filled with all the incentive that disappointment, ignorance of facts, and malicious falsehoods could invent to misrepresent my politics." And Thomas Jefferson as well. "Nothing can now be believed which is seen in a newspaper. Truth itself becomes suspicious by being put into that polluted vehicle." So it's the same rhetoric that we're hearing today. It's just, history doesn't repeat itself, but it often rhymes. Right.
Sure does.
Maybe it was said a little bit more eloquently back then.
Yeah.
And
they were
via someone's
above,
voice, not their fingertips on X or Twiter. Right.
They're above just standing there yelling fake news.
Yes.
Yes. Similar concept though. And again, I just want to take this back to the markets really kind of dealing and performing based on fundamentals. So the next few slides, it's not to be, not to make a prediction as to, which party will win, Republican or Democratic Party. But it's interesting. I mean, the markets have done well under both political parties. And I think it's really more about policies and fundamentals and what helps companies earn and perform well. So, this is it just simply shows the average S&P return, the performance of it under the makeup of Congress, and whether it was with a Democratic president or with a Republican president. You can see that, that there's nothing really to demonstrate a strong, significant outperformance under the leadership of one party versus another.
Right.
And so I don't know if you guys have a different take on this, but I think, again, just setting the stage for where we're heading in the back half of this year, this election year, these sort of slides, this one and the one that follows, I think are important, just reminders that, you had a lot of people think that when Trump was elected president, that the markets and the world would end.
Right.
And they didn't. They didn't. I mean, not half the country wasn't happy about it, and I get that. Mm-hmm. But the economy did well until the pandemic, generally speaking. And when President Biden won election, you thought that the green companies would have done great because of his agenda and part of what he ran on. And I think the numbers played out that maybe it didn't perform quite as well. But there were other parts of the economy that clearly did exceptionally well, large cap tech in particular.
Right.
Yeah.
So it's really about policies and,
Right. And it takes a while for those policies to take into effect, right? By the time one policy really is affecting an economy, it's diluted by another president's policy, which is diluted by another, which is diluted by another. There's actually, you have to give it to our forefathers for creating these checks and balances, because they did a pretty good job, evening it all out over the long run.
Which is why a split Congress ends up, with the least legislation, but the best market results over time,
in general,
I think. The next slide I think is great, Carmine. It just highlights the growth of being fully invested versus, only being invested during certain presidencies, and what a ridiculous nature that is. But you just miss out on more compounding time, because we know that 70% of years are positive, right?
Right.
Right.
Yes.
And then I know you wanted to dive into technology a bit too, right? And just the way that's shaping the world these days.
I think it's an exciting time to be alive. I mean, it's there's always troubling things that we're seeing in the news and in day-to-day life, and there's no getting away from that. I mean, we need to contend with that and hopefully come to better solutions. But I think the exciting part is this technological revolution. And I really feel as though we are entering this new kind of phase of hyper change, which we haven't really kind of had, I think, in a period of time. I mean, clearly with the internet, there was a lot that went on there in that time frame. And then I personally feel as though we kind of hit somewhat of a lull. I mean, we definitely benefited from the pickup in efficiencies and such. But, what's going on now with AI, I think is really impressive and exciting. But, I think it's good to kind of look at how technology has impacted us and improved lives. I mean, there's 4 categories here on this slide, and it shows some of the advancements that technology has helped with, and it's helped compress time. I mean, it's helped us get around more quickly. We used to use a wagon and then a steam locomotive, and now we're on jetliners. So getting from point A to point B, and that's based on technology and innovation. Expanded our knowledge. I mean, we see these pictures, in caves. That's how people used to communicate or record history. Then we went to parchment. Then we went to, the library. And now I remember getting encyclopedias at home was a big deal growing up.
Right.
Now, I can find these facts about Alexander and Burr, with three clicks.
3 clicks, yeah. Or ask AI to do it. Right.
True. Yeah, here you go.
That's next.
Right.
Just wait till it's a chip implanted in your brain, right?
Here it comes. Yeah. Personalizing experience. I mean, I think we all had, maybe 4 radio stations that might be broadcasting. And so we all had to kind of huddle around that. Where now I can choose whatever Netflix thing I want to watch, and my wife can be sitting next to me in her iPad and watching something completely different. I mean, it's much more customizable. And clearly, reduce costs and overall efficiency, just the way we do things. I mean, when we started making automobiles, it was done by hand. Henry Ford created the production line or assembly line. Now we're doing things in 3D printing, and robots are taking over a lot of that work. So, technology has evolved. It's making life easier. In many instances, it's making it better.
Right.
And I do think that we're on the cusp of, some really exciting times. And that last slide, this will conclude with this one last slide here, which is to the similar effect or similar point. It's that I think my takeaway of this was that there's concern about AI replacing everyone, and I've heard it from just about every industry, from actors and entertainers to people who are working on production lines and things along those lines. But I think the reality is, and what we've learned, is that technology will close some doors, but it will open others.
Yeah.
So a very poignant conversation I was having with my buddy at dinner just this past weekend was, his nephew was finishing up college and didn't think that pursuing additional academics or a desk job was for him. So he's going to be trained on becoming a Tesla mechanic. Now, we kind of joked, because if you've known mechanics, and I've had a few in my family, they tend to have very calloused, cracked hands from working with them, and they tend to typically have a little bit of grease under those fingernails as well. I think it'll be a very different experience for Tesla mechanics. It's going to be more, kind of programming, and I don't think that they're going to be doing the same things, but the role is similar. Get this vehicle back out on the road and moving. Right. But the skill set and the training is completely different. So we still need them, but they're going to be kind of going about their job in a different way. And there's way too many pictures on this slide to kind of describe, but they're reminders. I mean, how, the ATM was invented, and we relied a little bit less on tellers. Mm-hmm. Amazon, think about that, right? I mean, they used to just sell books, and it was kind of neat to be able to buy a book online, but now they sell just about everything, and in some cases delivered the same day.
Right. Well, you go back even further and you look at, other technological innovations like the transcontinental railroad and the automobile and the telephone. And you look at today, there's Amazon and Google and Netflix and Uber. And I just wonder, in 100 more years, what you can't even fathom what's next, right? But kind of makes the point of being diversified, not being concentrated in some of the stocks that are doing well today, because, they might be the dinosaurs in 10, 15, 20 years down the road.
Right.
For sure.
It's very true. And the thing I like about this slide that you're showing is the unemployment rates on here too. And it shows the average unemployment rate 6.4, and it shows the unemployment rate move over time. And it really fluctuates just right above and below the average, right? And while our population growth has been 10 times, right, over from 1870 to 2020, we've still been able to keep a pretty consistent unemployment rate. So people aren't losing their jobs, right? We're actually getting a larger population, and we're able to support that population through the advancements in technology.
Yeah. And I don't think that there's anything on the horizon that would point to this changing.
Right.
So I just think that is really what we should be excited about. It's an exciting time to be alive. Technology is going to do pretty exciting things. And, Adam, as you were mentioning earlier, I mean, it's fun to just sit around and fathom, what the future could look like. And even from a transportation perspective,
right.
how close are we to the Jetsons in moving around that way?
I'm not ready for that yet.
Personally,
I get a little motion sickness myself.
So that's what I had for you guys.
Yeah.
No, this is great. We really appreciate you coming on. And look, these, we call them isms, right? But they are turns of phrase that lead a lot to good investment behaviors. And that's what we're all trying to instill in our clients at the end of the day.
Right.
Right on.
Right. So should we do what's new?
Let's do it. Yeah, Carmine, talk to us. What's going on in your life? TV shows, books you've been reading, hobbies you've picked up.
Yeah. So, I mean, to be honest, we touched on what's going on in my life a little bit. It's been graduation season. There's been a lot of heavy lifting, figuratively and literally speaking, moving kids in and out and getting ready to move kids out. But that's really my life. My focus is when I'm not focused on clients and work, it's really about, my family. I take, great pride in helping them along, and, being the son of an immigrant, or immigrants, I should say, I feel it my duty to, set my kids up, to be in a better position than I was in. And
right.
I know when my parents made the very difficult decision of, getting on a boat with very little and going to another country, that was why they made that decision. So, that's been my focus. And fortunately, all that is going well. So in the little bit of downtime that I do have, quiet moments, my wife and I have been watching a couple things on Netflix. One that kind of is really close to home is the series Ripley.
Okay.
I like
I've
it.
heard of that.
Yeah, so it's interesting. I like it. It's the one thing. It's filmed in black and white, which is not what we're used to seeing, but it's shot so beautifully, and the scenery is fantastic. It's filmed in a lot of it's filmed in Italy, so the Amalfi Coast is featured, and I just think it's really well done. The acting is terrific. The production, directing, just top notch. And it's really pleasant. It's fun to kind of get through.
I have to look into that one. How many episodes is that?
It's not that many. I don't remember, but we're through. They're about an hour each, and if we're able to get through it, anyone is. And there's a handful of them. Less than 10, I think. But really well done.
I've heard of it. I think it's based off the same book that The Talented Mr. Ripley with Philip Seymour Hoffman and was it Matt Damon? We're in, but totally different vibe from that movie. It's on my list. Good to hear.
Yes. So especially if you have an Italian vacation coming up this summer, it's just this would definitely get you in the mood.
Oh, there you go.
If you're going along the Amalfi Coast, this will give you a good taste of everything that's to come.
Yeah, what a hot travel destination these days, the Amalfi Coast.
What was the HBO show recently that was in the Amalfi Coast? It was the second season. White Lotus. That one's that one's another good one.
Oh, I think that was in Sicily though.
Oh, you're right.
Palermo.
You're right.
Yes, but again, beautifully shot, right? I mean, I've been to Italy many times. I've not been to Sicily, but that was definitely a reminder that I should get myself down there.
There you go.
What about you? What about you, Austin? What you got for us?
I think we all should take a moment and appreciate that we have a new summer ahead of us. Do you guys remember how bad? I mean, maybe not you, Adam, but Carmine, you could probably relate how bad the weather was last summer here in New Jersey. I mean, it started out with the wildfires, right, that were keeping us indoors. That was surreal. I felt like I was in Dune, right? Whatever. What's that planet they're on? Whatever. And then I saw a stat recently that it rained 68% of the weekends in the New York area between June and the beginning of October.
Oof.
So you think about that. You think about someone living in New Jersey. Me, I live by the beach. Wanting to go out, be outdoors, and it was just horrible. So, knock on wood, hopefully we have a better one this year, but I just wanted to take a moment and appreciate that we have a new summer ahead of us and we hopefully can enjoy it.
Now, I asked you before we started recording because we don't communicate our what we're going to share on this segment beforehand, but I asked you if you had seen my notes before you put this down, but it's also on the topic of summer. I wanted to bring up a summer cocktail that I am looking forward to enjoying this this season. Last year, I feel like espresso martinis were very popular.
Sure.
Which I still love a good espresso martini. How could you not?
Right.
But
those you can only have like one or two, right? Maybe 1.5 before your heart starts to shake.
Unless you flip them to decaf. I don't know. Yeah. But spritzes have been popular of late. An Aperol spritz, Carmine is.
Yes,
I think I had my first in Italy, actually, while we were on that subject too. But
it's an Italian drink?
Yeah.
There you go.
I thought so. Yeah. Aperol is, yeah. But I would recommend going to a liquor store and searching for a bottle of Lillet Blanc. It is an aperitif, kind of similar to Aperol, kind of maybe not as bitter, but almost like a fortified white wine. And half of that, half of a seltzer flavored if you want. An orange slice is a really refreshing drink as well. It's almost like a wine spritzer as opposed to more of a bitter Aperol spritzer.
Nice. Yeah,
So
I'm
that would be
excited
my recommendation.
I'm excited for cucumber season. I love a good cucumber martini or like a cucumber mixed in with something.
You're a gin guy, right?
Yeah, gin guy. So it goes well with gin and tequila. So.
Yeah. Gin's not my thing, but I'll join you with vodka martini with a twist. How about that?
There you go.
Awesome. Carmine, thanks for coming on. We really appreciate it. To everyone listening, watching, please make sure you hit the like and follow button and subscribe, whether it's YouTube, Spotify, wherever you're listening or watching. And we will see you next month.
Great.
Thanks, guys.
Thank you.
See you.